Hi everyone, welcome to Cornell Keynotes. Today we're going to touch on the topic of Web3 and sustainability, climate impact, crypto innovations, and fintech regulation. My name is Will Cong. I'm going to be the moderator for today. I'm a professor of finance at the Johnson Graduate School of Management and also the Rod Family Professor of Management. I'm a founding faculty director for the Fintech Initiative, as well as the Digital Economics and Financial Technology Lab here at Cornell. My team and I have been researching on topics closely related to the development of crypto, DeFi, Web3, including introducing the research field of tokenomics, pointing out environmental damages from mining pools, cryptocurrency mining pools, as well as highlighting the issues with vertically integrated centralized finance entities, CFI entities, that includes market manipulation, so on and so forth. Today, I'm really honored to be joined by two distinguished guests, and they are Ari Redbord, Global Head of Policy at the TRM Labs, a leading blockchain intelligence entity that has collaborated with regulatory bodies around the world. Ari also serves as the Vice Chair of the CFTC Technology Advisory Committee. We also have Dana Gibber, a very accomplished climate tech entrepreneur and lawyer. She's the CEO and co-founder of Flowcarbon, a company that started in 2021 to amplify natural climate solutions through these financial technologies that we have. I'm also proud to say, or to claim, to be a college classmate of hers. So both of them are very prominent figures in the cryptocurrency innovation and policy space. I'm just going to let them to introduce themselves before we delve into the topics and the discussion. Ari, you want to start?
Sure. First of all, Will and Cornell, thank you so much for having me. I'm not sure I can do a whole lot better than you just did. But as Will said, I'm Ari Redbord. I'm the global head of policy at TRM Labs. We're a blockchain intelligence company, and we'll sort of, I'm sure, go deep into that over the course of the next hour or so. Prior to joining TRM, almost exactly 3 years ago, I spent about 11 years at the U.S. Department of Justice, prosecuting cases really at that intersection between money laundering and national security, so what we call threat finance, North Korea, Russian cyber criminals, Iran sanctions, those types of cases, terrorist financing. I then spent about 2 years at the U.S. Treasury Department working on many of those same issues, more sort of from the policy side. But yeah, really looking forward to the conversation today, and really excited to join Dana.
Thank you. It's great to be here as well. So I, as Will said, we started together as classmates in college, and I did then go to law school, although I can't claim like Ari to be a real lawyer because I worked in the federal court system focused on national security law, but then immediately left and started a SaaS company, a software company based on some of what I had exposure to in the national security space. The software platform was an AI-powered chatbot platform. We sold to enterprise retail customers for customer service and sales and marketing capabilities. I sold that company to a private equity firm in 2020. And at that juncture, post-acquisition, had the opportunity and privilege to get involved in some conservation philanthropy efforts. And that ended up being extremely eye-opening for me because as I started getting involved in these large-scale efforts run by international environmental NGOs to conserve some of our oldest growth rainforest land in South America, I realized, like many have realized, that reliance on philanthropy capital to do those kinds of projects is wholly insufficient for scaling those kinds of projects, and that in fact, there was a market mechanism called the carbon markets, which were incepted and designed to facilitate the flow of capital through a market-based mechanism to conservation projects other incredible nature-based efforts to sequester and remove carbon from the atmosphere, and then into technology projects that remove carbon from the atmosphere. And we can get into more about how the carbon markets work. But once I saw that there was this market mechanism that was so high potential, but that was missing a lot of key financial and technology infrastructure as a market, I, together with some co-founders, launched Flowcarbon to be active across the carbon markets on the supply side of the market at projects that do this carbon removal and reduction work. We help finance the projects. We use some engineered financial solutions to help institutional capital participate in financing those projects. And then once credits are issued, we monetize those credits. And what we are most well known for is pioneering the idea that both the data collection from projects as well as the sale of credits and the transacting in the resulting credits could and should happen on blockchain. And we think the credits could and should sell in part as blockchain-based tokens, carbon-backed tokens. And so I really look forward to the discussion as well, getting into some of that in more depth.
Thank you, Ari and Dana. I can't say enough how much I appreciate both of you joining us. I think it's a rare opportunity for leading practitioners and academics and policymakers to come together, right, to chat about these core issues. I'd like to just take a couple of minutes to provide the background information for our audience related to our theme and topic today. And throughout our session today, please feel free to pose clarification questions. We'll have about 10 to 15 minutes till the very end for more elaborate Q&A as well. Now, we all know crypto and blockchain space has seen tremendous growth and innovation over the past decade or so. But we've also seen major challenges recently, especially the past year. We've witnessed the collapse of the Terra Luna, which undermines investor confidence, as did FTX implosion. And recently, we've seen increasing scrutiny from regulators, such as the SEC, with lawsuit or litigation cases against Coinbase or Binance and the like, right, major players in the space. Yet the core technology keeps improving, even though that's not the main focus in the media in some way. For example, solutions to what is so-called the trilemma, right, in terms of scalability, security, and decentralization, has been proposed, including the switch from proof of work to proof of stake, faster, cheaper layer 2 solutions that can help us scale the processing of blockchain-based systems, oracles, not the company, but Oracle nodes or Oracle networks that enable real-world data use in smart contracting, which really allows us to connect across different blockchain ecosystems and on-chain, off-chain worlds. At the same time, risks like market manipulation, including wash trading, faking transaction volume, pump and dumps, ransomware attacks, crypto-related scams, they remain significant threats. Regulation is still evolving in this space, and we do see that the potential of crypto is still massive, but realizing that requires overcoming these challenges through technological regulatory innovations, which are very much related to the work at Flowcarbon and TRM. And ultimately, for crypto to go more mainstream, it needs to prioritize sustainability, and that's our core theme for today. It has two layers of meaning. One layer is the crypto sector has to build a more transparent, equitable, and sustainable system in order to revolutionize finance and make economy more stable, so on and so forth. And the crypto's future depends on walking the talk on sustainability. Now, the second layer is the technology itself has huge implications for sustainability at a more general level. For example, climate sustainability that Dana has alluded to, and other sustainability such as ESG reporting. Right, there has been pointed out that there could be issues related to misreporting or discrepancies in the data that's collected on ESG related issues. So the next decade is really going to determine whether crypto and blockchain can evolve into a sustainable force for good while mitigating all these risks. And I've chatted with practitioners and regulators quite a bit during my advisory work to, EVA Labs and also my role as senior economic advisor and senior economist at Chainlink, and also the work with government regulators. But I think it would be better to hear about all these issues firsthand from Ari and Dana. So what I hope to do is I'm going to ask Ari and Dana to introduce TRM and Flowcarbon a bit, just providing a bit more background on what you do as a company, as a team, before we delve into some of the more specific questions. I think we can ask Dana to start, if you wouldn't mind.
Sure. First of all, thank you so much for that framing. It actually mirrors how I often open and introduce the topics of sustainability and blockchain, which is bifurcating the discussion of the emissions associated with blockchain and kind of giving a state of play to address the pervasive narrative out there that blockchains are highly unsustainable. And then going into I think, much deeper and more interesting conversation around how blockchain as a technology is being leveraged in so many different ways as a force for good, which is, a direct quote from you just now. So I look forward to that topic, but happy to start by talking about Flowcarbon and the role that we play within that. So what we do as a company is we have a team of investment bankers and project finance specialists who unlock institutional capital and help it to deploy into projects that remove carbon from the atmosphere and keep carbon sequestered. Those projects can be nature-based, conservation, tree planting, afforestation, mangrove restoration, or they can be technology-based, direct air capture, the creation of biochar, which is a char product that takes waste wood, which sits on the side, decomposes and rots and emits carbon. You run it through a machine and it all of a sudden becomes a carbon sink. There's all kinds of processes you can do, whether it's in nature or utilizing technology that has a climate impact by removing or sequestering carbon. And these projects make up the supply side of the carbon markets, because if they meet a specific methodology that is approved by one of the there's really four major carbon credit issuers, then they can get issued to them what's called carbon credits. So think of a group of people that get together and they start what is essentially a business, tree planting, because they put in some CapEx, they put in some OpEx initially, they start tree planting, they apply to the issuer, so to speak, and they get a stream of carbon credits issued to them. And those then need to be monetized for revenue. That's the revenue in this business, so to speak. Not so to speak, a lot of these are for-profit businesses. And they monetize them by selling them to end buyers, which are often, almost exclusively, corporate sustainability teams that buy them as part of the corporate overall decarbonization plans or net zero plans, net zero commitments. So on the demand side of the market, you have corporations that are, many of them, 5,000 plus of them, are now have committed to quantifying their overall emissions throughout their operations and supply chain. So number one, they quantify what their emissions are. Number two, they make a specific commitment to reducing those emissions over time. There's a decarbonization or reduction component, and that's essential. And then the really hard to abate residual emissions that remain, because let's face it, in every operational business, or basically every operational business under the sun, there's going to be some need for carbon emissions in whatever you're doing, those you buy these carbon credits to offset them. So this is the carbon offset market, otherwise known as the voluntary carbon market. So Flowcarbon is active on the supply side of the market by providing institutional investors, traditional financial players, access to this project ecosystem in structures that work for them. Then once credits are issued, we are very active on the demand side of the market, multi-channel, in monetizing the credits. And so we sell over the counter to corporate sustainability teams, and we sell on marketplaces and exchanges. And what we are leading the industry towards is the idea that you can create a token backed by a carbon credit, and those can sell much more liquidly and transparently on blockchain exchanges and DEXs. And we can talk about why that's such a good idea. But the headline or the TLDR on that is it introduces price transparency for the first time, basically. You can imagine in a market that's 80% over the counter, there's very little benchmark pricing, which means forward price projections on the investments into the projects are nearly impossible. So these projects are super hard to underwrite for investors. Once you have a liquid trading token that represents carbon credits of different kinds, carbon credits from conservation projects, carbon credits from direct air capture machines. They come in varieties and they trade at different price points. You start to have benchmark prices associated with those project types, which helps the market scale tremendously. And the second thing it does is it opens up the market. It expands the demand side of the market because, again, as you might imagine, in a market where transactions only happen over the counter or on commodities exchanges, the only players that are participating are corporate buyers, sophisticated corporate buyers with big teams that know how to diligence, know how to participate, know how to onboard, and can navigate these very expensive intermediary structures, and know how can buy in very large volumes. When there's over-the-counter transactions, these are in big volumes. When you tokenize, you end up with a composable token that represents just one carbon credit, and that can be plugged into all kinds of protocols and applications. That expands the market significantly to much smaller players, to end consumers when it's plugged into consumer products in an automated way, etc. So we are excited to help expand the market on top of introducing price transparency and liquidity that is badly needed in this market.
Thank you, Dana. That's a great introduction to Flowcarbon. And Ari?
Yeah, I love all of that. And, it's interesting. I get asked all the time, sort of, what are the biggest challenges in the cryptocurrency space? And given my role and my background, they expect me to say something like, regulatory clarity, or is it a commodity, or is it a security? To me, it's use cases. And it's so fun to hear Dana talk about this really compelling use case for blockchain. I talk all the time about AML as anti-money laundering as a use case. I think it's been flipped where somehow, anti-money laundering is a huge problem in crypto, but really it's a use case. And that's sort of what we do at TRM. I'll start where you, Will, and Dana both started, and that is we believe that crypto is a force for good. This idea and movement of funds on blockchains, this idea of cross-border value transfer at the speed of the internet without intermediaries, right? Linking people who don't have access to traditional financial systems, to banking, peer-to-peer, is absolutely extraordinary. But illicit actors also want to move funds in large amounts cross-border at the speed of the internet. And what we do at TRM is, because of the native properties of blockchains, right? Transparent, traceable, immutable, we are able to have more visibility on financial flows than we've ever had before. I spent most of my life as a prosecutor investigating cases involving networks of shell companies and hawalas and high-value art and Russian real estate in London. There's no TRM for those things. You cannot trace and track and investigate the flow of funds on open ledgers. So what we do is we are a software tool. We are a SaaS business. We work with law enforcement globally, every three-letter law enforcement agency in the United States and really across the globe. And they're using us to build investigations. They have an address that they know is associated with terrorist financing or a hack or ransomware. They use TRM to track and trace the flow of funds to build an investigation. So there's a hack or a ransomware attack. The FBI or IRS criminal investigations uses TRM to track and trace those funds, hopefully to an exchange, a compliant exchange, a Coinbase, that they could process a subpoena and get more information and really build an investigation. And we've seen great examples of that lately in the Bitfinex hack, in the ransomware attack on Colonial Pipeline. But then we also are a compliance solution. That same tool is used by the largest crypto exchanges, DeFi protocols, NFT marketplaces, as that anti-money laundering piece of a compliance stack. So that's essentially what we're doing. I mean, in terms of the data science around this, really what we're doing is we're looking at the alphanumeric addresses, like those crypto wallets, and we're taking that information and we're layering it with threat intelligence. So we see Mujahideen raising funds on Facebook with a Bitcoin address. We take that address and we label it in TRM terrorist financing. And then we use machine learning and data science to extrapolate, right? Who is that address transacting with? Where are flows going? Where are flows coming in from? And we start to label blockchains to help investigators investigate cases, to help compliance professionals know that, hey, I don't want to do that transaction because I know that's either going to or coming from a terrorist financier. So like excited to kind of dig into all of that, but sort of that's what we do at TRM.
Got it, Ari. Yeah, that's a very concise introduction to TRM's work. I know we prepared a few themes to talk about, but let me just flip the order a little bit since we are on these topics, right, of TRM and Flowcarbon. Ari, you did mention about regulators, regulation. I'm sure, even though it's a question that's often asked, but it's still very rich space for debate and discussion. I'm just curious, what a typical project, right, collaborating with regulator would look like. I personally have looked into some data related to ransomware attack, and it's very interesting. It involves criminal gangs. They really run like a business. They try to do due diligence to figure out the victim's ability to pay so that they can figure out the right pricing, so on and so forth. I would imagine it's hard to kind of combat that, right? Especially when it's not confined to a particular country or jurisdiction. It would be great to hear, how you work with regulators to tackle this challenge.
It's a wonderful question, and there are different pieces to all of this. Or we can dig in a little bit to sort of the policy, the conversations that are happening globally in the space. How do we regulate in a more decentralized financial system without intermediaries? How should we sort of think about what policy looks like? Your question is slightly different, and that is sort of how are we working with regulators, law enforcement to really go after bad actors in the space? And the reality is any growing financial system is going to have illicit activity, right? Illicit actors follow the money. They are opportunistic. If you look at North Korea, for example, we put out 2 reports in the last 2 or 3 weeks. One basically showed about 2 billion in hacks stolen by North Korea in the last 5 years, about 200 million already this year. So the reality is, and they're following the money, right? They've moved from Bitcoin, which was about 97% of illicit activity in 2016 occurred on Bitcoin. About 19% of illicit activity occurs on Bitcoin today. The rest is in DeFi on other chains. And we're seeing North Korea follow the money. So we've seen major hacks on bridges and DeFi protocols over the last year or so, most famously the Ronin hack, which was against the Ronin bridge, which connects sort of the Axie Infinity game to Ethereum. And they stole $625 million, the largest hack, ever. So I say all of that to say, like, it is a real problem. But the reality is, because of those native qualities of blockchains, there are things that we can do. And the first thing is something we don't necessarily do, and that is hardened cybersecurity. There are a lot of people doing critical work in that space, And I think it is so important that when we're building today, whatever we're building, that we bake in, that we build as a foundation cybersecurity. It's really, really critical. And then the thing we do is we work with law enforcement and regulators globally to add friction to the money laundering process, right? We want to make it really hard for North Korea to move those funds off blockchains to spend on weapons and other types of destabilizing activity. Because the reality is, today, you can do all the moving funds around you want on blockchains, but you still need to off-ramp those funds to usable currencies. So oftentimes what you'll see, it's a race by law enforcement using TRM to those off-ramps where you have strict regulation today, right? We talk all the time about there needs to be more regulatory clarity in the crypto space. One place there's very, very clear regulatory clarity today, certainly in the United States, certainly with the Financial Action Task Force, which is sort of the global anti-money laundering standard setter, the regulation is very clear. If you're a crypto exchange, if you trade crypto for crypto, if you're a broker, if you're an ATM, you are required to have anti-money laundering controls. So where much of the liquidity is today, those off-ramps and on-ramps have solid controls. So we're working really closely with a combination of law enforcement and then also those on and off ramps to make sure that they're able to stop those bad actors. And I'll tell you, there's been a fair amount of success. Even though hacks, we're still talking, 200 million by North Korea, that is down significantly from where we were last year. We're seeing a lot more sort of the adoption of FATF standards. We're seeing large exchanges have better and better controls using better tools like TRM. So I think we're seeing a lot of it. It's one place where there's, I think, some real progress and quite a bit of clarity.
That's great to hear. It does sound a little bit different from what the media has been depicting, but I can definitely testify to what you said. After chatting with New York State Office of Financial Services and the like, people are really putting in resources to figure out the right policy to implement.
New York DFS is a fantastic example, right? Like we have regulators all over the world, and the Monetary Authority of Singapore and JFSA in Japan and the US Treasury Department. I talk about global regulators. I talk about New York DFS all the time. They already require today a cryptocurrency related business that has a license in New York State to already have anti-money laundering tools like TRM as part of their compliance stack. They have, stablecoin requirements already today. All the things we're saying, why isn't Congress doing? DFS has done a terrific job of getting out in front on.
That's right. And there could be potential issues related to coordination among the regulators, because we do have many regulatory bodies in the space. I kind of want to come back to the environmental sustainability, right? Carbon credit a bit, to what Dana was saying earlier about price transparency. What do you think is the biggest issue when it comes to price transparency? And more generally, right, how is Flowcarbon linking the technology to the problems that you pointed out earlier, right, in the carbon credit and carbon markets?
Yeah, it's a great question. I think in any market that's over the counter, predominantly, you have a lack of price transparency because there's no sunlight on these transactions. They're bilateral between a buyer and a seller, and nobody really knows the price point at which the transactions are happening. And that's very problematic for scaling a market, because when you want investors to invest in new projects, you need to be able to underwrite those investments. And to do that, you need to understand what the forward price projection is going to be on the resulting asset that's being created through the investment. So in this case, these are carbon credits, and it's very, very hard to project the price point forward with any degree of accuracy, again, because the market has no sunlight. And so the idea of tokenizing these assets, it's part of the, I would say, broader movement of tokenizing real world assets, where we see a lot of energy and focus in blockchain circles and blockchain investor circles right now, which is great to see. And in our case, what it means is taking these carbon credits, which existing carbon credits, which live inside of registry databases. I mentioned earlier, there's basically 4 main carbon credit issuers. They not only serve as issuers, but they are also the registries that log and track the transactions in the credits that they issue. So you're a project, you're doing direct air capture, removing carbon from the atmosphere, you're submitting your data to this registry, this issuer. They are issuing you credits in a SQL database that they maintain. And when you sell them, when you're the project that's selling them, you are either transferring them to somebody else's account in this SQL database, or you're actually retiring them on behalf of the buyer. What that means is the buyer actually wants to claim that they are offsetting carbon. And so you're taking your credits and you are clicking a little retire button next to them, which effectively burns them, so to speak. And then you get to claim the environmental benefit. You are using the commodity, so to speak. Now, what tokenization does is it takes the ownership of each individual carbon credit and confers that ownership right onto a token. And the token essentially serves, you can think of a warehouse receipt or a depository receipt. And that can be traded and transacted in through DEXs and exchanges in a much more transparent way. So all of a sudden you have 100 carbon credits sitting locked in this SQL database that nobody can see. But when Flowcarbon creates a token that represents each one of them and launches that, puts it into a liquidity pool or puts it on an exchange, those start to sell at a very clear price. And so all of a sudden you see the pricing. Now, what you can also do is start to group different carbon credits from different projects together to take the market from an extremely project-specific manner of transacting up a level of generality. And so what that means is, instead of carbon credits from tree planting project 1, 2, 3, and 4 selling in different transactions at different price points over the counter, so you don't even know what those different price points are, you group them together into a bundle and you mint tokens that represent the right to a credit in the bundle. And those start to trade at a benchmark price that now represents credits from tree planting projects. You start to have market segments of carbon credits with clear benchmark pricing. So that's the idea behind tokenizing carbon credits. It's one, to just take them from over the counter into a much more transparent and liquid environment. And the liquidity is further boosted by the ability to group these together. And then, as I mentioned earlier, you expand access because you start to be able to plug them into protocols and applications. Much smaller entities can transact in smaller amounts of them, as opposed to batches of 100,000 credits, let's say. And I guess it's important on that point to note that every carbon credit issued to a project represents 1 metric ton of carbon that was removed from the atmosphere or sequestered. And so when corporates buy those, or when anyone buy those, it's to offset 1 metric ton of emissions. And so if you're an individual or you're a small business and you need to offset 10 tons, you want to offset a conference and it's, 30 tons, a flight and it's 15 tons, you can't go into the market now and buy 15 carbon credits. They're sold in batch lots of 100,000, 50,000. So that also introduces the ability to transact in much smaller amounts, which is very beneficial as well.
I'm hearing a more inclusive ecosystem building and also better price discovery, liquidity, so on and so forth. And to me, and I think to all of us, it is important because we've been hearing a lot about cryptocurrencies per se, right? There's a lot of speculation and questions about whether there are fundamental values to these tokens. Now, here is a good example of how the technology can affect the real economy, can affect sustainability of the earth, and where tokens could provide real value. So I think that's fascinating to explore. Let me take a step back, right? Tying it to our main theme, and this is actually a question that I kind of plan to ask first. Are we still in crypto winter, given what has transpired over the past few years, and how to really make this sector more sustainable? Ari, you want to take a first step?
Yeah, no, for sure. I've never really loved the crypto winter either, analogy.
Yeah.
It feels to me like it's this time of hibernation and obviously downturn. And like when you look around the world, it's very much the opposite of that. In sort of every aspect, right? You have regulatory engagement. I mean, during the crypto winter, as it is, last year and a half or so, we have seen every major regulator around the world come out with consultations and guidance. We've seen, as I mentioned, the Monetary Authority of Singapore continue to put out guidance. We've seen rule books in the UAE, which is probably, as close as we have anywhere but Europe, to a comprehensive framework. We have MiCA, the marketing crypto assets legislation in the European Union, which is really the first comprehensive legislative framework for digital assets. And we talk about regulatory or legislative clarity. Now, cryptocurrency businesses that use blockchain technology know that they have access to 450 million people across Europe, as long as they fit the requirements to get a license in any one of those jurisdictions. Really, really extraordinary. That does not feel like a crypto winner to me. And then, you get to the US and everyone, I think there's a whole different conversation happening in the US. But one thing that stands out to me is that every branch of government, right, is fully engaged in this conversation in the United States today. You have these really critical cases in the courts, where you have US district courts deciding, critical issues. Is it a commodity? Is it a security? You have the executive branch, obviously, with enforcement actions, as you mentioned, SEC, CFTC, Treasury, but even much more, right? If we have now a White House framework on digital assets. Some good, some bad, but it's the entire executive branch weighing in this space. And then finally, Congress, which has been sort of hamstrung, from a political standpoint on almost everything over the last several years. We finally have some crypto bills that have at least moved out of committee in the House of Representatives. So we have the full U.S. government engaged in this space. So I think there's a lot happening, a lot of back and forth. But then when you just look at industry, right? I mean, just this summer, we had Circle, which is the most important stablecoin, USDC, go to 6 new blockchains, right? We've seen Fidelity and BlackRock like fully engage in this space. And I think the biggest news is PayPal. I mean, probably the most important financial institution in the world issuing a stablecoin, right? Like that does not feel like a crypto winner to me. So if crypto winner is just about the price of Bitcoin, maybe. But to me, it's such a broader, more interesting, sophisticated ecosystem than just that. And I think we're seeing a lot of progress. I was at a conference at the Philadelphia Fed last week, and someone commented, and I thought it was a really great comment, that like, in the age of the internet, right, there was no internet. So you were building in relative private, in academia and in business. Here we're building a new financial system on crypto Twitter, right? Like everyone expects things to move so quickly, but I think the magnitude of what's happening right here, it's probably about right on time.
Absolutely. And then you want to add to Ari's?
And it was at least smiling for a lot of what I was saying. So like that's usually a good sign that like I'm like.
First of all, I very much appreciate optimism, and I'm usually the optimistic one. And so, on the one hand, I agree with every single thing that you said, and I think there is so many great signals and signs that we're moving in the right direction. I would not say that we are there yet, right? Most institutional capital, right, and neither would you, obviously, but. Most institutional capital is still kind of standing back and not ready, willing, able to transact on chain or to move on chain in any meaningful volume. So there's still a lot of regulatory and ideally legislative clarity that is needed, certainly here in the US. And I think there's a lot of efforts afoot to move us in that direction. And we need to get there because there's so much promise that this technology represents. There are so many great use cases, and we need to provide clarity such that our institutions feel comfortable transacting at scale on blockchain networks. And so I would say, on the one hand, fully agree. There's lots of great things happening. All the examples you listed would be all the ones that I would list as well. at the same time, there's a ways to go, and we should be moving towards it expeditiously, towards more clarity, less regulating through enforcement action, clear legislation. Obviously, that all relates to the political environment that we find ourselves in. So, hopefully we can work things out and move in a good, productive direction there. I would add, and at the same time, if you think about historically over the last maybe 4 years, I think the three biggest either criticisms leveled against blockchain as a technology, or the three biggest red flags or obstacles that prevented people from engaging with blockchain would be the regulatory environment. The lack of regulatory clarity would be one. The security issues, which we already addressed in a previous question, and I think Ari, is doing great work. There's great stuff happening on the security front. Third would be the emissions and the sustainability criticism that's been leveled against blockchain networks. And there we've been doing a lot to clean up the problem. You have Gen 1 blockchains like Bitcoin and Litecoin that are still utilizing a proof of work consensus mechanism and still heavy on emissions. But basically all other blockchains, all of the Gen 2 blockchains, Ethereum, Solana, Celo, Aptos newly, they're all proof of stake. They have very low carbon footprints. A lot of them are making commitments to becoming carbon negative, which means that they, for whatever residual emissions they have to have operationally, they are buying offsets, for more offsets than the amount of emissions that they have. And so they are having a net, basically negative carbon contribution to the planet, which is phenomenal. They are encouraging ecosystems of protocols building on top of them that are committed to doing sustainable things. Flowcarbon is one of them. There's a whole movement called ReFi, which is basically comprised of protocols that are doing productive and positive things in sustainability, for lack of a more specific category definition. But certainly anything that is at the intersection of carbon markets and blockchain, of which there are a bunch of protocols and ecosystems developing, those are all very productive. And you see a lot of grant money and community funds going from the blockchains, L1s and L2s, to supporting these kinds of protocols. And so the narrative around sustainability and emissions when it comes to blockchain has had a dramatic improvement. Obviously, the Ethereum merge is the main headline there, right? Reducing Ethereum's emissions by 99%. And so you all of a sudden have a technology layer that is highly efficient from a carbon standpoint, is largely offsetting historical emissions. Most of the L1s and L2s have committed to doing that, and is offsetting more than their ongoing residual emissions, and are fostering these communities of climate tech innovation, basically. So there, I think we've made tremendous progress, at least on one of the major, actually on all of them, but certainly on this one.
Just to put a point on that, because I think Dana made a couple great points. Look, I think that everything she just went through just now was a technology solution to this, right? I think blockchains allow us to solve a lot of these problems using technology, right? The first is the regulatory clarity piece. And when we talk to businesses, we work with financial institutions, crypto businesses, they care what ultimately the answer is. But a lot of it is just tell us what to do, right? Like give us, we need to drive and just need to know what the speed limit is. Just give us some clarity around this. So I think that piece is really important. And that's where you need legislative action. I think on the AML piece, right? Blockchain intelligence like TRM, digital ID, zero knowledge proofs. Like there are things that technology can do to build that safety layer. And then last, I mean, this is your world, but like for you to just go through those technology, the environmental piece, they're all tech solutions. And I think that we have to maybe, look inward as an industry too, to just continue to put forward solutions to a lot of the problems that we know the policymakers are looking at. And they can be tech solutions that we're building. Just as one example, TRM and a whole bunch of other blockchain crypto businesses run something called chainabuse.com, totally open source, free website where it's like a Waze for crypto fraud and scams. You can basically just input, you've been the victim, you can input it, you can report to law enforcement through there, you make sure other people are not victims. There are things that we can do using open blockchains, right? Using that technology to better police ourselves. And I think that there's a lot of cool stuff going on in the space. And it's only in a crypto world, right? Like there's no other way to do this without open blockchains.
I totally agree with that. I'll add one other cool example, since we're giving cool examples. So I basically pointed to Bitcoin as an example of like what still remains as emissions heavy, while the rest of the ecosystem has moved in a very productive direction. But what's really cool, what you're seeing a lot, are that Bitcoin miners are starting to help speed up the renewables transition, because they are co-locating at the sites of new renewables projects that are not yet grid connected. So they're agreeing to co-locate there from the beginning. And then they're becoming the first demand-based like off-takers of some of the energy, especially energy surplus. So they're co-locating at these sites, and where there's a surplus, they'll consume the renewable energy that's being generated when the grid in that area doesn't need it. And so you're even seeing a lot of industriousness and innovation on the part of Bitcoin miners, who are obviously supporting the Bitcoin network, to help speed up the renewables transition. So there's a lot of really cool stuff happening. I will agree with that.
Absolutely. These are fascinating examples and points that you brought up. I do want to add to that technology aspect, the kind of economics analysis, because there is a fin in fintech in some way. And for example, when designing stable coins or stable tokens, there are many issues that central bankers have thought about for decades, and they are hard to do. It's not like just reinventing the wheel from engineering aspect to solve the problem. And when we think about sustainability of pooled mining or pooled staking for generating blockchain consensus, it's a technical possibility, but is that an economic reality needs to be figured out. I think those are also pretty important issues on top of the technological solution itself. Now, on that balancing between, optimism and concerns for the sector, I do have a quick story here. I do present around some of the research work at government agencies and research institutions, and sometimes I talk about the dark side of crypto. And one common question from the audience is, well, what are the bright sides to start with? I think there's a general perception of the many issues that we do face. For good reasons, we've seen the concerning aspect of CeFi, centralized finance, right? With centralized exchanges having all types of issues or concentration of market power. But it's a design question. It does not have to be that way. So that's actually related to one question from the audience asking about, well, we do know stocks on exchanges have clear price visibility, so on and so forth, right? Why is blockchain needed? I think whether we're talking about traditional finance, let's say equity exchanges, or centralized exchanges as a form of CeFi, or decentralized finance, right? With DEX, decentralized exchanges, or some algorithm-based stable coins. It's about economic trade-offs. None of them is perfect. From a research perspective, I think the interior solution is often optimal. Basically, you're taking good elements from TradFi, CeFi, DeFi, and figure out what would work best in terms of economic functionality or the objective that we want to optimize. Would love to hear your thoughts on that. How you envision, CeFi, DeFi, and TradFi interact going forward, and why do we need blockchain, right, for many of the issues? I think you already spoke to that, but it'd be great to hear more from you.
Sure, Dana, you want to kick it off?
Sure. So for carbon markets, blockchain is not needed. It's just better, right? This is an asset class. It exists. There are ways to buy and sell it right now. It's just entirely inefficient and illiquid and non-transparent. The reason blockchain is better, for starters, is because blockchain is an underlying database layer. It's a database. It's a way you store and then transact in information. And what a carbon credit is fundamentally is a digital asset that is created via information, via data. And so really, we start the story sometimes when we talk about it by saying it's a real world asset that we're tokenizing. So it's issued in the traditional way, and then we're creating a token that represents this asset. And that's very compelling. And there's benefits to that specifically, to just picking up the asset when it's already been issued and then creating a token that represents ownership of the asset. And for all the reasons that I've been talking about for this whole hour, that's beneficial in this market in particular. But what's really interesting, and what we talk about a lot internal to the carbon markets, so the carbon markets are one of the earliest and most active markets as a whole, market-wide, in evaluating and thinking through how to best use blockchain for the market as a whole. The market right now is dealing with a big reckoning, whereby it's experienced explosive growth. It's about to experience even more explosive growth by orders of magnitude. It's facing a lot of criticism about some of the methodologies and the way that carbon credits are being created and the accuracy of the data that's being used to create the carbon credits. Meaning, for those uninitiated, when you buy a carbon credit and it comes from a project doing something, did that project really do the something? And blockchain is phenomenal for intaking data in real time from systems, and then in a completely trustworthy, because it's trustless way, doing things based on that data. And so you can have ongoing monitoring of projects through remote sensing, looking at tree cover in a forest, reading the meters on a smart cook stove that is a much more energy efficient cook stove. That's a project type in the market. Intaking data from all kinds of devices, and then just reacting to that data and issuing credit based on it. So no longer are you relying on documentation that is created and submitted in Word doc form and an email form. All of a sudden, there's a lot of new technology that's being brought to bear to monitor projects in the carbon markets. And you can start reading that data, storing it on blockchain where it's completely transparent, right? It's auditable, and then issuing credits based against those data streams. And then the credits themselves are issued as tokens because you're already in a blockchain system. So now all of a sudden you have the creation of carbon credits happening where the underlying technology is blockchain, and then the issuance of credits commensurate with that. That does rely on blockchain, obviously. It's a blockchain-based system for doing this. And it's because blockchain is so fantastic for being an auditable, completely trustworthy representation of truth. And you see a bunch of really large corporate institutions and other TradFi institutions starting to leverage blockchain in that way. I think Ernst Young is a great example. They rolled out a blockchain-based system for tracking supply chain, the different data associated with their supply chain, just for tracking data in a completely trustworthy way, which is exactly what you need to do to create a carbon credit. Blockchain is a phenomenal use case. And so when we talk about applying blockchain in the carbon markets, there's tokenizing the assets, but then there's also going further upstream and actually creating carbon credits using blockchain as the database.
Yeah, I think Dan did a wonderful job with that. I mean, a lot of it would be applicable to cryptocurrency, just sort of as from a financial standpoint, right? I mean, like when you think about those native qualities of blockchains that we talked a lot about today, transparent, immutable, traceable, but also private, right? You can ensure that blockchain transactions are private using technology. So I think that this idea of being able to transact peer-to-peer across border without intermediaries is extremely compelling. There are certainly challenges to that. I think that as best I can with taking out my crystal ball, I do think we'll live in a world where there's optionality, where users can decide whether they want to transact in cryptocurrencies or central bank digital currencies or stable coins or on blockchains or using intermediaries. And I think there's going to be a lot more opportunities for choice, and I think that'll be absolutely critical. But from a pure banking perspective, there are people all over the world, millions of people that don't have access to financial intermediaries today, which means they don't have access to the financial system. And I think that anyone with a cell phone could have access to a network of computers where every transaction is logged and permanent on a public ledger is pretty compelling from a technology standpoint.
That's a very interesting point about plurality that you just raised. Because sometimes we hear blockchain and crypto, these are about decentralization, but decentralization is one extreme end of a spectrum. And if we talk about CBDC, which you mentioned, central bank digital currencies, a lot of the designs are centralized, right? Because it's operated by a central bank. But still, the technology can offer some elements that would make money programmable, make monetary policy transmission smoother, things like that. So that's very much related to this idea of having more choices, providing more choices to all the consumers and users. We are running tight on time. I do want to have maybe 1 minute each for you to kind of provide some remarks, forward-looking remarks on how the sector is going to evolve and what you think are important issues. And then we can go look at some of the questions from the audience. Dana, you want to start?
Sure. I mean, I think there's a lot of great stuff happening. There's a lot that's going into making transacting on blockchain much more secure, more compliant. And those two things, I think, are the, by far the most important keywords. You want to feel when you're transacting that it is both compliant and secure. Once we nail those two, then sustainable is super important and great as well. So secure, compliant, and sustainable, then it's kind of off to the races, because the various reasons why we all know blockchain to be a, if not superior technology, but a very unique and singular technology to accomplish a number of important objectives, trading and carbon credits being one. Once we can nail those three, it's off to the races. And I think we've talked a lot about the really positive momentum we're seeing across all three of those objectives.
Yeah, really quickly, it's much cooler to get to these questions. But this was really unique for me. I oftentimes find myself in these types of conversations with law enforcement and regulators or folks who are very much sort of just squarely in the crypto space. And it's so cool because to me, like, use cases are a challenge, right? Policymakers will move faster if we see more adoption. And people are using this technology more, sort of, that chat GPT moment, if you will, right? AI may have leapfrog crypto when it comes to sort of, policymakers on their mind, because we're seeing this mass adoption. And I think in order to have that mass adoption happen, we need these use cases. And it's fun for me to be able to talk about AML as a use case and to hear about sort of, sustainability, environmental impact from Dana today as well.
Thank you. And likewise, and I'll just follow up and add that engaging the real world is super important. Making blockchain a place where they can transact, but also engaging with the stakeholders there, right? Our mission is to bring the carbon market stakeholders and the key institutions that are the drivers behind carbon market activities onto blockchain and create a set of rules and frameworks for making them comfortable with carbon credits being tokenized. And that's, what we've been engaged in for the last 18 months. But it's super important to recognize that the real world and blockchain are the same. It's one world, right? And this is a means and a platform for certain things to happen, certain assets to be transacted in, certain data to be stored, et cetera. But it all touches the real world. And so you need, I think, a real professionalization, and that's happening dramatically, of the blockchain projects, the protocols that are being built, the teams that are building there, who are engaging with real world stakeholders and creating UI and compliance programs and interfaces that allow this to be usable. It all comes down to the use cases, I guess, is the main takeaway from today, because I'd echo that, which Ari very rightfully brought up.
Absolutely, these are excellent points. If I may just add one remark to that, I think thinking about business design and the economic aspects on top of data science and computer science would be equally crucial in the sense that when you think about designing token supply policy, it's essentially monetary economics meeting corporate finance decisions. And when you think about investing in crypto-based projects, there are asset pricing models beyond simple discounted cash flows, because we know many tokens don't have cash flows. At least they try not to have cash flows. to avoid being labeled as a security token. So I think that space is wide open. If you look into that more carefully, you probably can gain an edge over many other similar projects. I think it's a good time for us to take a look at some of the questions being posed from the audience. They're actually very interesting. One question is about, as the kind of number of coins or tokens grows and the whole space proliferates, do you think we'll see an increase in illicit activities? I think that's kind of more related to Ari's work.
Yeah, absolutely. Look, I think that illicit actors, as I mentioned, are opportunistic and will go to where the funds are. And as I mentioned, kind of at the outshoot, TRM did a report recently. I think it was provided in some of these materials, maybe, that basically talked about this shift from this Bitcoin only world where we were in 2016 to this world of exactly what the question asks. And that is, we have this now proliferation of assets and blockchains. And what's more important than ever, that if you're a compliance professional, if you're an investigator, if you're law enforcement, to have visibility on that entire ecosystem. So, when you think about TRM, sort of the difference in what we've built is that we cover about 28 different blockchains and, over 1 million different assets to make sure that we can track and trace the flow of funds in every NFT, for example, right? Or on Solana or Polygon or other chains that are not Bitcoin or Ethereum. So I think it's absolutely critical. Look, we live today, or a few years ago, we were in kind of a Wild West town, like you see the gun battle, right? And there's no infrastructure. We're now moving very quickly to New York City, right? Where it is going to be complicated. There are going to be bridges connecting different neighborhoods, right? Different blockchains. And we have to be ready for that. And when you're a blockchain intelligence company, you need to have intelligence on as much of that as possible. And that's what we're enabling. So like everything else, look, the ecosystem is going to become more sophisticated, but so are the tools, so is the technology, so are the investigators. And that's kind of, I think where things always ultimately end up.
That's great. And I think there are definitely forces pushing in different directions, the regulatory side and also the innovation side, which is something interesting to at least keep a watch over. Let's just take one more question in the interest of time, and we can wrap up the conversation. Of course, feel free to continue the discussion. We are all available over emails, and I think both Ari and Dana would love to chat more with our outstanding audience here. But let me just mention one more quick question, and then we can wrap this up. Do you believe that Fed announcing their interests in digital currencies, and actually many regulatory bodies or government agencies are expressing more interest or concern in some way in digital currencies, in blockchain, will that inspire more innovation for American interests and further regulation? Dana, you want to take a first stab?
Yeah, I mean, we're both lawyers, but Ari's more of a lawyer than I am. But what I'll say, if I understood the question correctly, it's there's a lot of regulatory interest in blockchain, regulatory concern in blockchain. And I think it really just speaks to what we said earlier, which is we need rules. I think, Ari, you used a great analogy. We want to all, if you're building a blockchain, all the projects that I know about, all the venture-backed projects, all of the projects that have real use cases, we all want to drive within the speed limits. You just have to tell us what the speed limit is. I think if anything, hopefully the keen focus by regulators on blockchain is galvanizing legislators to take action. You did see a lot of legislative activity, nothing that came to fruition yet, but both in the Senate and the House, you saw a number of efforts to define digital assets, to categorize them as, securities or commodities or something else in a productive way. So I think nobody likes to see legislation through enforcement action, but perhaps as the regulators are really keenly focused on the blockchain space, it'll continue to impel forward legislative efforts. Ari, I'm sure you have much to add on that.
It is the sort of it's a big question, and look, I think crypto is global. I'm in New York City today. I live in Washington, and I'm in New York today. I go to Brussels next week. Like, it's to meet with people talking about these exact same issues all over the world. But look, I mean, I hope this is okay to say. I'm an American. I want this technology to be built here. Yeah. I'm building here, right? Like, I testified about a year or so ago before the House Financial Services Committee on this exact question, right? Like, what do we need from a regulatory standpoint to not lose this competitive, the sort of competitive race? And, part of my answer to that was we need to ensure that we have regulation that encourages innovation, encourages the type of building that occurred in Silicon Valley in the internet era. So I think we need that regulatory clarity that Dana is talking about. But there's a lot that excites me. Look, China is building a CBDC, but 99% of fiat-backed stable coins are in US dollars today. So I think there's a lot, and users are in the United States. VC venture capital is in the United States. So I think there's a lot going for us, but there is a timing issue. We need that clarity, and we need it, relatively soon to ensure that it stays here.
Yeah, it's almost that we have that in spite of the lack of regulatory clarity, not because we have enough of it such that, there's venture dollars and teams building here. It's more like in spite of the regulatory uncertainty.
Absolutely. Yeah. And we need to get our act together so it stays. Yes. That's exactly right.
Right. We are starting to see a bit of a talent flight, which is
absolutely
extremely not in anyone's interest if you're American.
Yeah, I fully agree with what you said. I've worked with a few government agencies outside the US as well, Bank of Canada, Monetary Authority of Singapore, Asset Management Association in China. What I really appreciate with the regulatory environment in the US is it has taken a gradualistic approach, which allows the innovation to still to evolve, and also the regulatory clarity is being developed or being introduced in some way. So we probably have to wait a little bit, but at the same time, I think just the fact that the government and regulatory bodies are willing to listen to different voices, I think that's a huge plus, right? There's open call for response from academic research, from practitioners, so on and so forth. I think that's very valuable. Without those, I think it's there's great promise in terms of building more American interest and strength in this sector. With that, I think it's actually a good time to wrap up our discussion, at least for now. I just want to thank both Ari and Dana again for joining us for this wonderful, lively discussion on Web3, blockchain, sustainability. I know these are broad topics, but they are also very timely topics. Definitely a lot of food for thought that we can continue exploring after today's keynote session. Thank you again, Dana and Ari.
Thanks for having us. Yeah.